Welcome to this week's Monday Market Minute. I want to talk not only about the performance of the markets last week, but this week I want to talk to you about why it is that our strategies look nothing like the stock market performance and why that's a good thing. So first, taking a look at last week, it was not a great week in the market. All the indices were down. NASDAQ only down about 0.25%, S&P almost 2% though, and the Dow almost 3.5%. We're off to a great start on Monday. We're going to try to keep that up the rest of the day today and the week. But as I said, I want to talk to you about why it is that we look nothing like the market. We use a strategy called sailing and rowing, where during good times, we just open up the sails, try to get market performance. But during those difficult times, we get out the oars and try to work the markets. Now, here's the thing. We're not going to be right all the time. If you look in the middle left side of this, we're right about 70% of the time. By right, meaning we beat the benchmark, the S&P 500, about 70%. We're getting positive returns about 84% of the time. Now, during good times, you could see both us and the S&P go up, although the lines are somewhat different. And that's what I really want to point out to you is they're not going to look identical because it is a different approach and a different strategy. But most importantly, when the market goes down, we're getting out of the way, not only avoiding losses, but trying to capture gains during those tough periods. That's why overall, in the end, we end up with better performance. Not only that, but with lower risk. You can see the risk number here in the 40s, much lower than the stock market. So that's why we look much different than the market. That's the goal and the objective. I know there are days when it's not a lot of fun to watch, but overall it pays off. If you have any questions, give us a call. Check out our website, wealthep.com. We'll talk to you next week.